Hey, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And to say the last couple of weeks have been a roller coaster ride would be a significant understatement for investors that have struggled to figure out how to navigate the excess volatility we've seen over the last couple of weeks and to determine how to go about investing in this type of market environment. Um, First off, it isn't easy if you find yourself confused and perplexed as to how to navigate this market. um, it's not easy because a lot of the things that we provide is sort of beyond analysis when uh, the president decides to completely change and make decisions that are a complete 180 from what they were 24 hours ago and 48 hours ago, and just reverses course on things that were meant to provide clarity, but as a result of the rapidly changing news environment, makes a lot of analysis sort of moot. There were, I can't tell you how many times analysts in the last week have had to adjust their models based on changes in the news. And just as they're presenting kind of their updated models, everything gets wiped out and they have to start all over again based on the newest changes. And they don't have any idea of whether next week things will be different. So if you feel lost, if you feel confused, you're not the only one. So what I'm going to try to do is take a look at the charts and try to give you a better sense for how we're viewing this market as of the current um, uh, as of the current market environment. Um, so let's take a look at where we currently are. If we look at the S&P 500, the big level that we have to pay attention to is 5,500 because we broke below that level on the back of the tariff news. And obviously, last Wednesday, we got the news that President Trump was going to pause the tariffs for 90 days. That led to one of the biggest intraday rallies we've seen in history on the S&P 500 and major equity indices. However, what's interesting is that despite that quote unquote good news, we could not get back above 5,500. We actually rallied right up to 5,500 and subsequently got rejected. And after getting that rejection, we've been making our way back up to 5,500 again. And this is really the big test here over the next couple of days to see, can we get back above 5,500 and show that the equity markets have strength, or do we fail at these levels and potentially start turning lower? So this is really the big level that I think investors should be paying attention to here over the next couple of trading sessions, um, as to whether we can get above it. The other catalyst that we really have to pay attention to right now is earnings season. We're heading into earnings season. So far, early reports have actually been fairly positive. If you look at kind of some of the reports from Delta, from JP Morgan, they all generated reports that were better than analyst expectations. However, both of those companies did choose to be far more conservative with their, Delta pulled guidance altogether for 2025. They were the ones who first started sounding the alarm bells back in January, end of January, beginning of February, about the slowdown of consumer spending. JP Morgan has also provided a much more cautious outlook for 2025. But overall, they did beat earnings, which is a positive start to the year. And we'll have to see whether if other companies follow in their footsteps with regards to reporting positive earnings expectations. Now, I will say the bar has been set relatively low this particular quarter. So there is a higher probability of companies beating earnings this quarter, which could provide a bit of a catalyst for equity markets to find the momentum to get back above 5,500. But if we fail to get it back above 5,500, that's really where we continue to maintain a more bearish view here on the equity markets. The other thing to consider at the moment is the fact that implied correlation has shot up significantly over the last couple of weeks, meaning the stocks within the S&P 500 are far more correlated to each other right now than they were 2 weeks ago. They're more than double the correlation that we saw 2 weeks ago. And what that means is that stocks are moving in tandem with each other. That's a challenge for stock pickers. When all stocks are kind of moving in conjunction with each other, there's less alpha in picking individuals' names, and suggest that it's an environment that's better for trading baskets of equities, such as ETFs like SPY, QQQ, and these types of market environments. So at the moment, our preference is to pull back from picking individual stocks and look at kind of the market as more of a macro, bigger picture perspective. And the bigger picture on the equity indices remains the fact that if you look across all of the major indices, you look at the S&P 500, you look at the NASDAQ 100, you look at the Russell 2000, and you look at the equal weight S&P 500, we are all still below prior support levels that have now turned into resistance levels. So no market has claimed those resistance levels yet. I would say technology with the Qs is probably the closest at the moment. And we'll be watching those levels pretty closely this week to see if we can get back above those levels. A failure to get back above those levels turns the market more bearish. I will say the cat feels like it's out of the bag, even though we've taken a pause on tariffs for 90 days. It doesn't quite feel like we could just get back to as if the tariffs weren't put in place, even if all other countries that have been put on pause manage to somehow negotiate a deal with the US, which at this point doesn't feel likely that all countries will be able to do that. Maybe some countries will, but there certainly seems to be some countries that will largely go into have tariffs 90 days later, unless somehow President Trump decides to completely reverse course on his whole plan with tariffs. That is, at this point, also a possibility. But unless that happens, it feels like the cat's out of the bag, and you can't really put it back at this point. Which means that corporations will certainly be much more shy about making investments in this type of environment where there's a very large amount of uncertainty. The one silver lining we were talking about, early last week, was the fact that once the tariffs were announced, at least we had a lot more certainty around what the tariffs will look like. And that got wiped out on Wednesday with the 90-day pause, because all of a sudden what felt like clarity was now complete chaos again. We have really no idea as to what will actually happen, because rules or what has been stated seems to change on a daily basis. So the lack of certainty, the lack of clarity on what's actually going to happen is causing a lot of angst. And that is the damage that I see being done to the US economy as a result is the problem, because theoretically, the tariffs are meant to rebuild manufacturing here in the US. Bring manufacturing back on shore, bring production back on shore to the US. However, in an environment where the tariff levels are so uncertain, I don't think any major investments will be made to reshore manufacturing here in the US until there's a clear policy that's being stated. And I really don't feel like that's going to happen anytime soon. And that's going to have some major ramifications here for the US economy in the short run. So that is kind of where we currently stand. My base case is more on the bearish side because we haven't gotten above those major resistance levels. And my hunch is that we're going to have a tough time getting back above those levels and staying above those levels over the next few weeks, next few months, because, like I said, the damage feels like it's been done. Even if we do take a 90-day pause, that 90-day pause just adds more uncertainty, and that uncertainty at the moment is not a good thing for equities. So at this moment, what I'm not going to do is spend too much time picking individual stocks and really think of this as more of a macro picture review. Commodities have managed to stabilize itself a little bit after what was a pretty significant drop on last week's news. High yield corporate bonds is one that we're paying attention to here right now. We're just flirting with the major support and resistance level here around 77. Now, the credit market is incredibly important, meaning the bond market is incredibly important to pay attention to in this market environment. If credit investors are concerned, that's going to lead to uh, some major issues. And at the moment, with interest rates kind of spiking over the last week, credit, or concerns around credit is going to be top of mind for bond investors and for equity investors. We should be paying very close attention to what the bond markets are telling us here right now, because the bond market is giving us some signals that not all things are okay. The VIX retreating, but even that retreat is still putting it above 30%, which means that investors are still expecting elevated volatility over the next 30 days. You have the 10-year yield still, sitting around 4.4% here. The rise in 10-year yields is definitely a concern because every 100 basis points that we rise in terms of interest rates on the 10-year yield equates to about $100 billion more in terms of what it's going to cost the US government to service its debt. We're rolling, somewhere between $7 to $9 trillion in debt this year in the treasury market. And what we roll it to, and what interest rate we roll it to is going to be very important because, like I said, for every 100 basis points, that's going to equate to about $100 billion in additional cost to carry that interest. Which is no small amount, and which is why the reduction of federal spending is so important for us to keep the U.S. Treasury market back in, we'll call it working order, if you will. And we'll discuss that a little bit here in a second, because what is not good is that as a result of last week's news, when equity sold off, Treasury sold off as well. These are typically asset classes that are inversely correlated. When stocks fall, bonds typically rise because we sell riskier assets to buy safer assets. But when these trade in tandem with each other, that speaks to the fact that something is starting to break. At the moment, there's still a bit of speculation as to why this is the case and whether this is a short-term dynamic or this is a longer-term structural issue that can be a bigger problem down the road. If treasuries are no longer seen as a safe haven for risk assets, meaning when it's time to sell riskier assets like equities, and we don't find it safe enough to park it in US Treasuries, that becomes a big problem because we sort of take for granted the risk-free nature of US Treasury markets, which is why it's always used as a safe haven, right? When things hit the fan, you put your money in bonds because bonds are safe. Bonds are quote unquote, or US Treasury bonds are quote unquote risk-free. But if we find ourselves in an environment where the amount of US debt is starting to get so large that investors are concerned as to whether or not the US government can continue to service its debt going forward, especially if you look out 10, 20, 30 years when you're buying a 10-year bond, 20-year bond, 30-year bond, and you're concerned as to whether the US government will be able to pay off its debts or the debts that it'll owe to you in 30 years. That is a problem if there's a concern around the safety of US Treasuries, and that will cause a major financial crisis in itself. That would spiral pretty significantly out of control for both the Treasury and the equity markets. So that is, in my opinion, the much bigger picture that investors should be paying attention to, and sort of in the short run, ignoring the tariff stuff because that's just noise right now in comparison to much bigger fracture that we're starting to see here in the financial markets, which is the quote unquote safety of the US Treasury markets. Now, this could be just a short-term dislocation between the Treasury and equity markets where funds had to sell off treasuries, last week to raise capital, and that caused the sell-off alongside with equities, and that we might see, we did see the auction last week, run fairly smoothly, which is a good thing. But this is something that we really have to keep a close eye on and see that the correlation between equities and bonds goes back to a negative correlation, to kind of alleviate some of the fears that the US Treasury market is losing its safe haven status. If this persists, that would be a big problem, in my opinion. And I think that is what investors need to keep their eyes on at the moment. Less so on tariffs, more so on whether or not the US Treasury market is stable and seen as risk-free. Um, Outside of that, when we look at kind of the markets here, the dollar index is also one that we should be paying attention to here right now, because we are in an environment with rising interest rates where the dollar should be rising, but instead of rising, what we're seeing is the dollar selling off. This is also another dislocation that is concerning as to the safe haven status of the US dollar. This is all tied to the previous comment about treasuries, as to whether or not the US dollar is seen as a safe haven and seen as a funding currency. Globally, we know that that is starting to wane in terms of the dollar being used as the global reserve currency. But this is really something that we also have to pay attention to. And these are the risks that extended tariffs have on the US equity markets and the US bond markets overall, even if the tariffs in the long run fix some of the more structural issues that we have with manufacturing and just the general trade deficits that we run. In the short run, the bigger issue here is the debt markets, and how they are being perceived by investors globally. Obviously, China being one of the largest holders of U.S. debt makes it a little bit more difficult for them to sell their holdings and sort of um, create a bit of a run on treasuries, because if they did that, they would be effectively shooting themselves in the foot, because they're one of the largest holdings of U.S. treasuries. So it's a bit of a catch-22 there, with China being one of the largest holders of U.S. treasuries and potentially using it as a quote unquote weapon against the US when they actually own a significant portion of the debt. So that is the one thing that perhaps at the moment is preventing China from selling US treasuries on the open market to create more panic here in the US, is the fact that they own so much of it. So it's not particularly easy to navigate all of this, but hopefully that kind of gives you a clear sense for what is more important, what we should be paying attention to in this market environment. Now, if we look at the individual sectors here, what we've seen is mostly, actually, sorry, before we move on to the sectors, let's talk about gold a little bit, right? So as equities sold off, treasuries sold off as well, which is unusual, because usually when stocks sell off, treasuries rally. Instead, what we've seen rally over the past 6, 9 months is gold as a safe haven. Gold has actually provided a far better safe haven than the US dollar and US treasuries, which traditionally are your typical safe haven assets. So in this market environment where investors are seeking safety as they sell off riskier assets, gold has been a net beneficiary of that, and gold mining stocks are ones that I think are still going to maintain a attractive investment for investors who like gold as an asset class. We've seen oil tank recently below the 52-week low to the 60, to the low 60s and high 50s. So far, we've stabilized a little bit here in the low 60s on the West Texas Intermediate contract, and that really reflects some of the shift in both supply and demand that we expect in a slowing global economy. So with that, let's turn to the individual sectors here. We clearly see a more defensive positioning when we look at the individual sectors because technology and consumer discretionary both continue to underperform the S&P 500 by a pretty significant margin. Um, and at the same time, you have sectors like financials, consumer staples, uh, healthcare, utilities. These are the ones that are outperforming the S&P 500. So much more defensive sectors are outperforming the S&P 500, which is not a particularly bullish view here on the equity markets when you have the more defensive sectors outperforming the growth sectors here at the moment. So we'll see if that changes course over the next week or so. But at the moment, it is pretty firmly the more defensive sectors that are outperforming at the moment. Um, and then looking at some of the, the industries, you look at home builders continues to underperform, semiconductors continue to underperform. Semis have kind of really fallen off a cliff and have really failed to get back above some major resistance levels here. So semiconductors remains fairly weak going forward. But overall, when you take a look at kind of the macro picture, equities are at a pivotal juncture here, kind of testing a major resistance level, and the question is whether we can get back above those levels. The treasury market and the credit market are sending some warning signals at the moment with the sell-off that we've seen in treasuries alongside the sell-off with stocks. And and the and the fact that we see from a positioning perspective the sector rotation model continues to favor more defensive sectors over growth sectors here at the moment, suggests that equity markets or the overall risk asset markets are at risk of further downside. On the S&P 500, that 5,500 level is really what we need to pay attention to here right now and take a look at some opportunities. If you do want to take a look at some opportunities in individual stocks, you really want to look for um, potentially bearish stocks that have relatively high exposure to the tariffs or tariff uncertainty. Walmart's a good example of stocks that will likely, have to eat away into its margins if the tariffs for China are put into place. If they're not able to pass on 100% of their additional cost to consumers, that's going to hit squeeze margins for stocks like Walmart, which are already trading at pretty high valuations. And that's really how you want to think about this market. There are a few undervalued stocks as well. But in order to play those undervalued stocks, you really have to have a more longer term view, in my opinion, than trading these as a short term play. Um, so that's kind of where we stand from a macro perspective. Like I said, it's really really difficult to navigate the current market that we're in. So if you're having trouble, if you're finding that being difficult, just don't worry. You're not the only one. But that's kind of why we are here every single Tuesday morning to try to give you that overview as to what we should be paying attention to from a macro perspective, from an individual stock perspective, and giving those updates so that you can stay informed for your investment decisions. With that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of where we currently stand with the equity markets and how we're viewing potential changes within the equity markets as well. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.